All right. Today we are going to be dissecting the concept of inflation and taxation in capital budgeting. Once we are done with that, then we proceed to discussing or to calculating, to start solving questions. Possibly we may be able to solve only one illustration today because the concept that we want to discuss, inflation and taxation, cannot take us more than 1 hour. So we spend the remaining hour on the calculation. All right. So far, so good under capital budgeting. We have talked about the introduction to capital investment decision. We talk about the procedures involved in carrying out capital budgeting. Then we talk about the characteristics. We also explain the methods of project evaluation. All right, whereby we talked about the net present value technique, internal rate of return, modified internal rate of return, project duration. Then we went on to discuss the non-discounted cash flow methods, where we discuss the payback period, accounting rate of return. Then we now came back to discuss the discounted payback period. Thereafter, we move to discussing the concept of relevant cash flow. All right, because on the day of your exam, the kind of scenario you are going to see at this level, if at all examiner is going to test capital budgeting question, the scenario will be something you're already familiar with. So the only issue you are going to have there is your ability to interpret the question. All right. Therefore, that's what I took my time to explain the likely items that you are going to meet on the day of your exam when you have any question under capital budgeting. All right. So, and that is what we discussed last time. Today, we are going to be having the impact of inflation as well as taxation in capital budgeting. All right. So this class is not to be explaining or to be defining what is inflation, what are the types of inflation. No, that's not our target. Key points, what are you supposed to know under inflation? That's what we want to discuss. However, when you talk about inflation, inflation represents the general increase in the prices of goods and services, leading to a decline in the value of money. All right. When there's inflation, the purchasing power of money will fall. The amount of goods and services that money can buy will reduce as a result of inflation. Therefore, when a company is contemplating or when a company wants to evaluate projects, it is essential to then incorporate the effect of inflation in the cash flow as well as the discount factor that will be, discount rate that will be used to evaluate the project. Because in reality, certainly inflation will impact the cash flow that the project will generate, and it is only essential to incorporate the impact of inflation when determining the financial viability of the project. So again, there are two types just for explanation purpose. There are basically two types of inflation. We have general inflation and then specific inflation. Any inflation that affects, okay, the general inflation is the one, is the increase in the average prices of goods and services in the economy. And it is usually measured by the changes in consumer price index. All right, this is general inflation. All right, the general inflation will affect both the cash flow as well as the discount rate, the cost of capital to be used to appraise the project. But when you talk about specific inflation, the specific inflation is a type of inflation that affects, okay, that affects the element of the project or the component of the project that you want to evaluate. For example, when you want to appraise a project, you will need revenue, right? Revenue You can have production cost in terms of direct material cost, direct labor cost, direct expenses, variable overhead. Not only that, we may also have some specific or incremental fixed costs. All these items that I just mentioned may be affected with different inflation rates, and specific inflation rates will affect each of them. All right. So this is what we are talking about as per the specific inflation. However, our major focus under inflation is number one, how to convert money cash flow to real cash flow. Because on the day of your exam, if you have any question under capital budgeting, you may likely have such a scenario. How do you convert money cash flow to real cash flow, or real cash flow to money cash flow? You do the same thing. We also talk about how to calculate or how to estimate discount rate. We also have money cost of capital, real cost of capital. What are the general rules that you need to take into consideration when you want to appraise a project under capital budgeting? So these are the things we are going to focus on in this class. So every other item in this material, you can just go ahead and read them through. But specifically, for exam purpose, these are the things we need to, and in practice, these are the things we need to consider. Therefore, for the purpose of inflation, there are two types of cash flow. All right, there are two types of cash flow. We have money cash flow. We also have real cash flow. Okay, what do you mean by money cash flow? Money cash flows are cash flows that incorporate the possible effect of inflation. I repeat, money cash flows are cash flows that incorporate the possible effect of inflation. All right? And except otherwise stated, all cash flow given in the question will be assumed to be money cash flow. Now, let me take that again, because this is the thing you are going to meet on the day of your exam, and you need to know what to do. When you talk about money cash flow, we said that money cash flow are inflated cash flow. Money cash flow has already been inflated. They are cash flows that include the possible or incorporate the possible effect of inflation. They have already been inflated. And if in a question, examiner did not tell you anything, it means that the cash flow given to you is money cash flow. All the cash flow given to you are money cash flows, if examiner did not tell you anything. All right, so that is basically what money cash flow is all about. Then the second one is real cash flow. The real cash flows are cash flows that do not include the possible effect of inflation. They are cash flows that are stated in today's prices, year zero prices, year one prices, or current value terms. I repeat, real cash flows are cash flows that do not include the possible effect of inflation. They are cash flows that are stated in today's prices, year zero prices, current value terms, or year one prices. These are real cash flow. Once you are given a question, for example, examiner tells you that the revenue in the first year is 2,000 naira per unit. Because examiner has mentioned in the first year, so you should know that that is a real cash flow. Another way examiner can state it is that you may be told that the incremental fixed cost is currently 1,500. Because examiner has told you currently, it means that they are real cash flow. Because real cash flow are cash flow that are stated in today's prices, year zero prices, year one prices, or current value terms. All right. So by the time we begin to solve questions, you are going to be seeing what I'm talking about. All right. So, but first thing first, you need to understand that Money cash flow are cash flow that include the possible effect of inflation. They are inflated cash flows, whereas real cash flows are cash flows that do not include the possible effect of inflation. They are cash flows that are stated in today's prices, year zero prices, current value terms, or year one prices. These are real cash flow. Now, the next thing we are going to discuss under this is how to convert money cash flow to real cash flow or real cash flow to money cash flow. How do you do this? All right. So, in a question, if you are given money cash flow, an examiner wants you to use real cash flow. How do you convert the money cash flow to real cash flow? All right. Generally, if you want to convert, for example, you want to convert money cash flow to real cash flow, what are you supposed to do? Now, that means the cash flow, if you want to convert money cash flow to real cash flow, it means that the cash flow given to you include inflation. There is already inflation in the cash flow given to you. So you now want to convert it, you want to remove the inflation. That's why you are calculating real cash flow. Therefore, in this case, we are going to make the real cash flow the subject of the formula. So I would then say real cash flow equal to the money cash flow given to me, which I want to convert to real cash flow. I will then say money cash flow multiplied by 1 plus general inflation rate. Let me reduce that. 1 plus general inflation rate raised to power minus n. So when you are converting money cash flow to real cash flow, it simply means you want to discount. So you are simply discounting. You are reducing it because your money cash flow already included the impact of inflation. So you now want to convert it to real cash flow. You want to remove the element of inflation. To do this, you are supposed to discount. So you are discounting the money cash flow to achieve the real cash flow equivalent. All right. So that's what you need to do. And that's the same thing. That's the same thing that you have here. All right. That's the same formula you have here. Whether you use this one or you use this one is the same thing. All right. So how do you then convert real cash flow to money cash flow? Okay. Let's convert real cash flow to money cash flow. How do you do this? Real cash flow does not include inflation. So if you want to convert it to money cash flow, it means that you want to compound it. You want to increase it. You want to increase the real cash flow to the money cash flow equivalent. In this case, we are supposed to make money cash flow the subject of the formula. So this will then be equal to real cash flow multiplied by 1 plus general inflation raised to power n. When you do this, you are simply compounding it. We are compounding the cash flow. We are compounding the money cash flow in order to arrive at the money cash flow equivalent. So you are supposed to compounding, okay? We are supposed to compound it. So that's that. This is how to convert real cash flow to money cash flow equivalent. All right. So, of course, in year zero, at year zero, money cash flow is the same thing as real cash flow. You know, in year zero, n will be equal to, if n is equal to 0, that means, and you know, anything raised to power 0 will be equal to 1. Therefore, money cash flow will always be equal to real cash flow at that year 0. All right. So this is how to convert money cash flow to real cash flow or real cash flow to money cash flow. Generally, By the time we begin to solve questions, you will not be making use of any of these formulas that I just mentioned. All these formulas you have here, they will be useless because it is already implied in the question. By the time we begin to solve it, you will not be making reference to all of this. I will show you how we are going to be doing that. Okay? But in any case, it's good to know, right? Then the next one will then be discount rates. You can call it discount rates, cost of capital, or rate of return. It's the same thing, right? So just like you have money cash flow, for the purpose of inflation, we also have a discount rates. And we have money discount rates and then real discount rates. Okay? So the money cost of capital, also known as nominal cost of capital, money rate of return, or money discount rates, is the cost of capital that includes the possible effect of inflation. Okay? Money cost of capital is the cost of capital that includes or incorporates the possible effect of inflation. The money cost of capital has already been inflated. There is an element of inflation in the money cost of capital. All right. So if in a question you are given cost of capital, an examiner does not tell you whether it is money cost of capital or real cost of capital, you are going to assume it is money cost of capital. Okay, you are going to assume it is money cost of capital. Generally, money cost of capital is used for discounting the money cash flow. You are supposed to use money cost of capital to discount money cash flow. Now, the second one is real cost of capital. The real cost of capital is the discount rate that does not include the possible effect of inflation. It is the cost of capital or rate of return that is expressed in real terms. It is the cost of capital that is stated in real terms. That is real cost of capital. All right. So what I'm trying to say in essence is that if in a question, examiner has given to you real cost of capital, for example, and you want to use money cash flow, that means you need to convert the real cost of capital to money cash flow. Again, if in a question you are given money cost of capital and the examiner wants you to calculate real cash flow, then that means you need to convert the money cash flow to money cost of capital to real cost of capital, because the cost of capital you are going to use for the purpose of evaluation must be consistent with the cash flow. All right. Money cost of capital for money to discount money cash flow. Real cost of capital to discount real cash flow. Okay. Now, it is possible in a question, you may want to calculate money cost of capital or real cost of capital, depending on what is available in the question. Generally, when you want to do this, you are supposed to use artificial effect formula to be able to calculate your cost of capital. All right. So you are supposed to use artificial effect formula to calculate your cost of capital under inflation. So in this case, according to Professor Ivan Fisher, 1 plus M, 1 plus money cost of capital is calculated as 1 plus real cost of capital multiplied by 1 plus general inflation rate. This is the original formula by Ivan Fisher. This is the original formula. And that's why I usually call this one equation 1. So from this equation, we can calculate money cost of capital. We can calculate real cost of capital. We can also calculate the general inflation rate. All right. All you need to do is to make the variable you are looking for, you make it the subject of the formula, and that's all you need to do. Therefore, if you now want to determine M is money cost of capital, R is real cost of capital, I is general inflation rate. So from this original formula, if you want to calculate money cost of capital, that is, you want to make M the subject of the formula, what are you supposed to do? In this case, that means all what you have on the right side will still remain the same. The only difference is just that the one that you have, this 1 plus m, the one that you have here, will then move to the right side. Therefore, to get the money cost of capital, it will be 1 plus real cost of capital multiplied by 1 plus general inflation rate, all of this minus 1. This will give us money cost of capital. This is the formula for calculating money cost of capital. Again, if you want to calculate real cost of capital, if in the question you are asked to calculate real cost of capital, or maybe you have calculated, you are using real cash flow, and then of course the best thing is to then use real cost of capital to discount the real cash flow. So in this case, from this original formula, I can get my real cost of capital. I want to make R the subject of the formula. Therefore, to make R the subject of the formula, I can't just remove R from this side. I can't just remove R like that, because 1 plus R multiplied by 1 plus I, they are together. I can't just leave one. Therefore, to do this, for me to be able to separate R from the rest, I need to divide both sides by 1 by 1 plus I. In this case, you are supposed to divide both sides by 1 plus I. I would then say R equal to 1 plus M over 1 plus I. So you divide both sides by 1 plus I, then minus 1. The 1 is the one of this M. I mean, the one of beside the high, beside the R rather. So it's what you have there. So that is the formula to calculate the real cost of capital. What's wrong with you? I'm trying to delete. It's painting. Okay. Now the last one, of course, this is the formula for real cost of capital. So if you now want to calculate general inflation rate, if in the question, certainly if you want to calculate, if you are not given general inflation rate, then you may be the one to estimate it yourself using the Fisher effects. So you want to make high the subject of the formula. To do this, the same way you calculated the real cost of capital is the same way you are going to calculate the general inflation rate. So in this case, you want to make high the subject of the formula. I would then say 1 plus M. You divide both sides by 1 plus R, because 1 plus R is multiplied by 1 plus I. The two of them, they are together. So for you to eliminate R, then you need to divide both sides by 1 plus R. And that's why here will be 1 plus R, then R minus 1. So this will give you the formula for calculating, this is the formula for calculating the general inflation rate. All right. So you have to master this. You just have to master it, because you don't know what will come out, the kind of the scenario the examiner will print for you on that day. Every one of them is important. Okay. Please ensure you know it. So like I said, M is the money cost of capital, R is the real cost of capital, then I is the general inflation rate. Now, so these are the basic things you need to know in terms of impact of inflation in capital budgeting. You must know how to convert money cash flow to real cash flow, or real cash flow to money cash flow, as well as how to calculate money cost of capital, real cost of capital, and including general inflation rate. All right. Not only that, examiner can even give you a bonus that you should explain real cash flow and money cash flow. All right. So you need to know them. Now, what are the basic general rules you need to consider if whenever you want to appraise a project? What are those basic rules you need to take into consideration? The first rule is that money cash flow must be discounted using money cost of capital. I repeat, for the purpose of project evaluation, money cash flow must be discounted using money cost of capital. That's rule number 1. Rule number 2, real cash flow must be discounted using real cost of capital. I repeat, real cash flow must be discounted using real cost of capital. Rule number 3, money discount rates should not be used for real cash flow. I repeat, money discount rate, that is money cost of capital, should not be used for real cash flow. Rule number 4, real discount rate or real cost of capital should not be used for money cash flow. I repeat, real cost of capital should not be used for money cash flow. So these are the things you need to take into consideration. But most importantly, this is what you are going to be using on that day if you have any question on capital budgeting. At this level, if you are going to have question on capital budgeting, there must be inflation. Examiner will give you inflation. You are going to test the impact of inflation and taxation. So you must know what to do. All right. Therefore, there are basic things you must take into consideration, which is the major key thing there, The first one is that if in the question, the cash flow given to you are stated in year 1 prices. If the cash flow given to you are stated in year 1 prices or first year prices, it means that you should start inflating the cash flow starting from year 2. I said, if in a question, cash flows given to you are stated in year 1 prices or first year prices, inflation should start from year 2. That is, it should start inflating from year 2. You don't inflate from year 1 because the price given to you is already first year prices. So you are supposed to start inflating from year 2 because that year 1 price is the base year price and you don't inflate the base year price in that particular year. Okay, so for example now, if in a question we are told that selling price in year 1 equal to 2,000 naira, you are given a selling price of 2,000 naira, and examiner has mentioned year 1. That means this 2,000 naira is year 1 prices. So if you now want to inflate, let's say for example you are given inflation rate of 5%. So and then the useful life of the project is 3 years. In this case, if I want to inflate my selling price, I will say inflation at 5%. I will do for year 1, year 2, and year 3. The selling price given to me in year 1 is 2,000. This one will be 2,000. I will not inflate year 1. I will go to year 2. Inflation must start from year 2 because the cash flow given to me is in first year price. Therefore, if I now want to do for the year 2 and 3, I will just say 1.05, 5% plus 1. That will give us 1.05. Okay, 1.05 multiplied by 2,000. This will give me 2,100. Then, if I want to do for year 3, what I have in the calculator, which is 2,100, I will then multiply with 1.05. So that will give me 2121. Here will be 2121. With this, I have inflated the selling price. This is how to incorporate inflation in cash flow. This is what is expected of you. If you want to use primary school method, then I can say, alternatively, I can say selling price for year 1, year 2, and then year 3. So to use primary school method, I will do 2,000 2,000, 2,000. I will then come here, inflation. We are given inflation of 5%. So here will be 1.05 raised to power 0, 1.05 raised to power 1, 1.05 raised to power 2. Okay, I will then use my calculator. 1.05 raised to power 0 will give us 1. 1 multiplied by 2,000 will give us 2,000. It will not change. This is the inflated selling price. Okay, then 1.05, let me bring my calculator. 1.05 raised to power 1 equal, that's 1.05 multiplied by 2,000. We have the same thing as 2,100. Then this third year, for the third year, 1.05 raised to power 2 equal, whatever you have in your calculator, multiply by 2,000. Multiply by 2,000. That's 22. This is giving me 22. Did I make a mistake? Let me do it
Yes,
again.
you made mistake. The first one is wrong, sir. The first
Okay.
third year is wrong.
Oh, so it's supposed to be 2205.
05.
That means the first one is not correct. Let me check again. 1.05 multiplied by 2,000 equal 21. Then multiply by 1.05. Oh, this one's supposed to be 2205. Thank you. 2205. All right. So whether you use, this is what is expected of, this is the method you are supposed to use on the day of your exam because it is faster. All right. If you do it one after the other, if you do one by one, no problem, but it will take time. It will waste your, you are still doing this. I'll move to the next question. All right. So whichever one you do, you will still get the same thing. So what I'm trying to explain here is that if in a question you are told that cash flow as stated in year one prices or first year prices, it means that your inflation should start from year two. The fact that I said inflation should start from year two does not mean that your N is equal to 2. Your N will still remain 1. You can see this one in this particular example. You will see that I started from 0 raised to power 0 raised to power 1 raised to power 2. All right. So the fact that I said that inflation should start from year 2, you can see in the first year, I did not, it's still the same 2,000. The 2,000 does not change, but inflation started from year 2. So what I'm now saying is that the fact that I said inflation should start from year 2 does not mean that your N is equal to 2. Your N will still remain 1. You are starting from year 1, year 2, and you continue like that in that order. So that's what you need to do. That is what you are going to use on the day of the exam if you have any question on capital budgeting. Then the second one is that if cash flows given to you are stated in today's prices, year zero prices, or current value terms, then inflation should start from year one. So what is usually, I've never seen any question where examiner give you today's prices or year zero price. It is always current year prices. But in any case, the bottom line is that if you are given cash flows that are stated in today's prices, year zero prices, or current year prices, it means you should start inflating the cash flow from year one. Inflation should start from year one. Okay, so that is basically these are the basic things that you need to take into consideration. All right, and this is all about inflation. This is all about impact of inflation for the purpose of capital project evaluation. This is all about inflation. However, please take your time. Ensure you go through all the information you have in the material in relation to inflation. All right. So at this point, let's talk about impact of taxation. So, but before we go into that, let me know if you have any question for me. Now, one thing I need to remind you is that you will see me here that I was using 1.05 raised to power 1, 1.05 raised to power 2, 1. So, I told you earlier today that when you want to convert money cash flow to real cash flow, I gave you a specific formula that you're supposed to use. And I said that by the time you begin calculation, we are not going to make reference to those formulas because it is implied. So what I mean, so in this one now, because our selling price is stated in year one prices, so that means we want to, because it is stated in year one price, it means that this selling price is a real cash flow. So we need to convert the real cash flow to money cash flow. So what I just did here, the formula I used, which I did not write out, is money cash flow. We said it is equal to real cash flow multiplied by 1 plus general inflation rate raised to power n, because we are compounding it. So 1 plus, we are assuming that the selling price, the inflation rate is 5%. Therefore, 1 plus 5%. So that's what gave us the 1.05 that we use to inflate. So generally, we don't make you reference to this one when you are doing your calculation. All right. So that's that. Let's move on to the impact of taxation in capital budgeting. How do you incorporate taxation in investment appraisal? That's what we want to discuss. Okay. Generally, when a company incurs qualifying capital expenditure in non-current assets, for example, a company purchase furniture, plant and equipment, machinery, and stuff like that. So when a company incurs qualifying capital expenditure, the company is entitled to claim capital allowance on the non-current assets. Okay, the capital allowance is granted to companies for incurring qualifying capital expenditure, all right, in a particular year. So when the company incurs qualifying capital expenditure, the company is entitled to claim capital allowance on those qualified assets. Now, there are three major reasons for incorporating tax in capital investments. There are three major reasons for incorporating tax. One is for tax liability. You are incorporating tax in your project evaluation because of tax liability. Tax liability will be determined by multiplying the company tax rate on the taxable profit. So you multiply company tax rate on the taxable profit to get the tax liability. You remember when we calculated cost of capital, when we calculated NPV under the redeemable preference share or redeemable debt, we calculated NPV. In those ones, we don't have anything like taxation, all right? So we are just told that we are just given tax rates, but we do not calculate anything like tax liability. So, but in real time, when you want to appraise a project, practically, you are supposed to incorporate the impact of taxation. So what we are now saying is that the primary purpose of incorporating tax is to determine the tax liability, the amount of tax that you are going to pay on the project. Then two, to achieve is to determine the tax savings on the capital allowance. So you are supposed to determine the tax saved on the capital allowance. The tax saved on the capital allowance will be calculated as the capital allowance multiplied by the company tax rate. That will give you the tax saved. All right. And the third one is the timing of the cash flow. That is, when is the company going to pay the tax or claim the tax liability or claim the capital allowance? Is it in the current year or in arrears? So all of these are what the essence, are the reasons for incorporating tax in capital investment. Now, there is no way we are going to talk about tax without talking about capital allowance, all right? Because the cost of the project, it will be huge. All right. Remember what we said earlier when I was explaining the concept. We said one of the characteristics of capital budgeting is that it involves huge capital outlay. A significant amount of money is required to undertake capital project. So when a company incurs such costs, especially if they purchase qualifying qualifying assets, then the company must claim capital allowance. So for the purpose of finance, there are 4 types of capital allowance. The first one is initial allowance. The initial allowance is allowance granted to a business once in the lifetime of the assets. Initial allowance is the allowance granted to a business once in the lifetime of the assets. It is claimable only once in the lifetime of the asset. That is initial allowance. So far, of all the past questions I've seen so far, there's none that include whereby, there's no question whereby initial allowance is given. So it has always been annual allowance. But in any case, once you have initial allowance, if you are given initial allowance rate in the question, just multiply the initial allowance rate with the cost of the asset. So to get the capital allowance, you are going to claim for the first year. Then the second type of capital allowance is annual allowance. Annual allowance is an allowance claimable every year until the final disposal of the assets. Is an allowance claimable every year until the final disposal of the assets. Okay, that is annual allowance. Now, balancing allowance and then balancing charge, they are similar. Balancing allowance and balancing charge are similar, but they are different. Okay, what do you mean by balancing allowance? Balancing allowance represents the difference, whether you call it balancing allowance or balancing charge. Both of them represent the difference between the tax written down value from the preceding year and the sales proceed at disposal. All right, so the two of them, they mean the same thing. However, balancing allowance is claimable when the tax written down value from the preceding year is greater than the disposal value. When the tax written down value is greater than the sales proceed or disposal value, that means the difference is balancing allowance. Let's say, for example, you are given an asset that has tax written down value of 500 million. The written down value of this asset is 500 million, and the asset is disposed. The asset is disposed at a scrap for 300 million. So because the worth of this asset, which is 500 million, is more than what the asset is sold, the difference of 200 is called balancing allowance. So we are saying that when the tax written down value from the preceding year is greater than the sales proceed, it is called balancing allowance. So balancing charge, like I said, balancing charge is defined the same thing as balancing allowance, because when you talk about balancing charge, it represents the difference between the tax written down value and the sales proceed. But balancing charge will occur when the tax written down value from the preceding year is less than the sales proceed. So again, let's say, for example, you have an asset that has a written down value of 300 million, and this asset is now disposed of for a scrap of 200 million. Therefore, sorry, this one is let's say this one is 400. All right, so this asset worth 300 million. The written down value of the asset is 300 million, but the asset is disposed of for 400. That means the company has gained has gained 100 million naira at disposal. Therefore, that 100 million naira difference will be taxed in the hand of the company. This is what is called balancing charge. So when the tax written down value from the preceding year is less than the sales proceed, it is called balancing charge. Balancing charge is a liability to the company. It is a liability to the company. So this is how to treat balancing allowance and balancing charge. Balancing allowance is a claim by the company. Balancing charge is a liability that the company will pay to the tax authority. So that's different between the two. All right. Now, the next item we are going to discuss under impact of taxation is how to estimate capital allowance. How do you calculate capital allowance, or what are the methods of calculating capital allowance? Basically, capital allowance can be computed using straight line depreciation method or reducing balance basis. You can use straight line depreciation method or reducing balance basis, whichever one. Examiner will tell you. But if the question is silent, you are not told whether you should use straight line depreciation or reducing balance basis, you can decide to use any one and then you state your assumption. Whichever one you do is what examiner will mark for you. But in most cases, examiner will tell you how you are going to claim your capital allowance. So if you are talking about the straight line depreciation method, it means that it's the same amount. The capital allowance to claim for every year will be the same. All right. So, but reducing balance basis will be, we are going to be multiplying the capital allowance rates on the tax written down value, on the written down value. All right. So that's basically the method of calculating capital allowance. Now, what are the timing of cash flow? You know, I told you there are three purposes. There are three reasons for incorporating tax. One is for to determine tax liability. Two, to determine tax saved on capital allowance. Then three is the timing of the cash flow. So far, we have talked about tax liability. We have also talked about capital allowance, or tax saved on capital allowance. Then we have also talked about, now we want to talk about the timing of the cash flow. Timing of the cash flow simply means when to pay tax, when the company will pay tax liability, or when capital allowance will be claimed in any relevant year. So now, generally, tax liability can be paid in the current year. This means the year the company makes the profits is when you are going to pay the tax. Or tax can be paid in arrears. In arrears means after 1 year. All right. Arrears means after 1 year. It means that the profit of year 1 will be taxed in year 2. Profit of year 2 will be taxed in year 3. So when you have 1 year lag, so it means that you are paying tax in arrears. So this is what we mean by the timing of the cash flow. You want to know when is the tax liability going to pay, or when are you supposed to claim the capital allowance? Of course, capital allowance must follow the pattern of the tax liability. Usually, capital allowance will follow the patterns of tax liability. What do I mean? If tax liability is paid in the current year, then capital allowance must be claimed in the current year. If tax liability is paid in arrears, then capital allowance must also be claimed in arrears. So they work hand in hand. They are 5 and 6. Capital allowance and tax liability, they are 5 and 6. Okay. Now, what is the main reason for calculating capital allowance? The essence of capital allowance is to reduce tax liability, because you want to reduce your tax you are going to pay. That's why you want to claim capital allowance. All right. So that's the primary reason for incorporating or of estimating capital allowance. Now, the last area we are going to touch in this is to show you how to calculate tax saved on capital allowance. How do you calculate tax saved on capital allowance? All right. So Again, the tax saved on capital allowance is intended to reduce the company's tax liability. And to calculate the tax saved on capital allowance, you are supposed to multiply the company tax rate with the capital allowance already computed. All right. So you multiply company tax rates on the capital allowance computed. It will give you the tax saved on capital allowance. So to do this, you can use primary school method like you have in this format. You can use primary school method. What do I mean by that? Let's say, for example, you want to calculate tax saved on capital allowance. So you are going to create about 4 columns, one for year, the other one for description of item. You have the cost of the asset, then you calculate your tax saved. Now, you are starting from year 0. So in year 0, you are going to have the cost of the assets. So you are going to put the cost of the assets under the cost, the column for cost. So you then go to year 1. You want to claim capital allowance. So to do this, you then go to the question and check whether you are given initial allowance rates. If you are given initial allowance rates, then you then say initial allowance rates multiplied by the cost of the assets. This will give you the amount you are going to claim, the capital allowance you are going to claim. Because remember, initial allowance is an allowance claimable once in the lifetime of the asset. So once you are given initial allowance rates, just multiply with the original cost of the asset. So that will give you the amount you are going to claim. In that same year 1, you are going to claim annual allowance. So you are going to multiply annual allowance rates. Examiner will give it to you, the rate. You multiply with the cost of the asset. The same cost you have for initial allowance is the same cost. So you multiply, then you add it to the initial allowance amount. So this will give you the annual allowance the capital allowance you are going to claim in the first year. This is the capital allowance claimable in the first year, and that's what you are going to put here. So you then deduct from the cost of the asset whatever you have will then represent the written down value at the end of year 1. So you then move to year 2. Year 2, going forward, you are going to be claiming annual allowance, depending on whether or not you are given, whether capital allowance is claimed using straight line depreciation method or reducing balance basis, whichever one. Just go there and determine your capital allowance for each year. Let's say, for example, for year 2, and we are told that it's on reducing balance basis. If it is on reducing balancing basis, I'll just be multiplying the annual allowance rates on the tax written down value. Okay, so I will multiply with this, then whatever I have, I will get this one. I will deduct again in year 3. In year 2, at the end of year 2, I will have the written down value. Based on this hypothetical table, the final answer on the final year of this asset is year 3. So in the final year, I need to compare the written down value with the sales proceed, whether it will result in balancing allowance or balancing charge. Anytime you want to calculate your tax saved on capital allowance, in the final year of the assets, you must compare the sales proceed with the written down value, whether you are going to have balancing allowance or balancing charge. Therefore, I need to compare what is the sales proceed after year 2. Whatever I have, I will deduct the written down value. I will deduct the sales proceed from the written down value. So whatever I have can give me either balancing allowance or balancing charge. All right. So the value that I have, let's say, for example, this guy is 200, written down value is 200, and this one is 150. Disposal value is 150. Because 200 is more than 150, then it will be balancing allowance. But if, let's say, the sales proceed is 250, that means written down value is less than the sales proceed. That means it will be balancing charge. The bottom line is that if the difference between written down value and sales proceed is positive, it means it is balancing allowance. But if it is negative, it means it is a balancing charge. Okay, it will be balancing charge if negative. So that's what you need to do. That's what you need to do. So this is now to now calculate this. All these things we have calculated. Let me show you again. All the capital allowance you have calculated. This guy here. Okay. Then this guy too. And then this guy. They are the capital allowance for each year. They had the capital allowance for each year. So if you now want to calculate tax saved on the capital allowance, you are supposed to multiply company tax rates. You multiply company tax rates on the capital allowance for each year. That's why you are seeing all this star here. So you are going to multiply, let's say for example, the company tax rate is 30%. So you are going to do 30% of this one. You come and post. Again, 30% of this one, you post. 30% of the last one, then you post. This can either be balancing allowance or balancing charge. That's what you need to do. Finally, if I want to confirm, because you are not supposed to claim more than the capital allowance you are required to claim. Therefore, you may want to confirm if what you have calculated as tax saved on capital allowance is correct. So to do this, you must ensure that the total tax saved, to get the total tax saved, it will be capital allowance, it will be cost of the assets minus the sales proceed, minus the sales proceed, then multiply by company tax rate. This will give me the total tax saved I'm supposed to claim. So whatever I have here at the end of the day must be equal to what I have here. The total of these ones must be equal to the total of these ones. Okay? Let me shift that thing. Let me shift it away. So what I'm saying is that if you want to confirm that you had everything, this will give you total tax saved. Total tax saved, TTS. So what I'm now saying is that if you want to confirm if you have not overclaimed your capital allowance, or underclaimed your capital allowance, you can use a formula to do that. So you can say total tax saved is equal to the cost of the assets minus scrap value or sales proceed multiplied by company tax rate. So whatever you have here must be equal to what you have, and the two of them must be equal. All right. So if they are not equal, maybe due to rounding, then you need to make the final answer equal to the number you are looking for. So this is how to calculate tax saved on capital allowance. This is how to calculate tax saved on capital allowance. The final thing we are going to discuss is for me to show you the format that you can use to calculate NPV. What is the format to calculate NPV? Let me see if I have a bigger space there that I can use. No space. All right, let me stop sharing this. Let me stop sharing this and move to the working notes so I can quickly show you the format. Now, on the day of your exam, if you want to calculate NPV, internal rate of return, all right, or modified internal rate of return, is the same format that you are going to use to estimate your net present value. Okay, so let me just format. So if you want to calculate NPV, let's say, for example, okay, let me just say calculating net present value. The kind of net present value we calculated under cost of capital is not the same thing here. All right, because under capital budgeting, your cost of capital, your NPV is going to be very, very voluminous. Under capital budgeting, your NPV calculation, the scenario will be longer relative to all those things. The ones that the NPV we calculate under cost of capital, they are just simple ones. That's not the kind of thing you are going to see under capital budgeting. All right, and that's why this particular format will be used to estimate net present value or internal rate of return when you are given multiple variable. This columnar format is used for calculating NPV or internal rate of return when you are given multiple variables. All right. In the question, you are given sales value, you are given variable cost, you are given incremental or attributable fixed cost, you have inflation, you have taxation, you have working capital, you have so many variables in the question. Therefore, you cannot use the simple table. It has to be the columnar format that I want to present to you now. So using columnar format, let's say, for example, this project has 3 years life. Therefore, you are starting from year 0. You do for year 1, you do for year 2, then you do for year 3. You create additional column for workings, because you are supposed to show your workings. Okay, so you come here, put your Naira sign. Let's say this is in million. All right, so you are from this format, the first item will be your sales value. How do you determine the sales value? You go to the question. You are going to be given selling price. Our assumption is that you have inflation and taxation in this question. Therefore, you are going to be given selling price. Before you multiply selling price with the unit sold, you are supposed to inflate the selling price. Okay, you inflate the selling price. After that, you multiply the inflated selling price with the number of units sold to get your total sales. Then you come and post. This will be the working one. I will go back to the question again to go and check if I'm given variable cost. At times, the variable cost may be given to you in total. At times, examiner may give you direct material, direct labor, direct expenses, and variable overhead. Whichever one you have, you should know what to do at the right time. But in this particular format, we're assuming that we have the variable cost in total given to us. Again, how do I calculate my total variable cost? I will multiply the variable cost per unit. First of all, I will inflate the variable cost per unit for the relevant years. Then I will now multiply with number of units produced. So that will give me the total variable cost. Then I will come and post. This should be working number 2. Of course, it's a cost. It has to be in brackets. Again, I will go back to the question to go and check if I'm given incremental, direct, attributable, or specific fixed cost. Whichever one I have, I will come and post. Let's say we have specific fixed cost. If you like, you can just, instead of working for the specific or attributable fixed cost, you can just come here, put the inflation rates, just multiply. You increase the specific fixed cost, just post immediately. No need to do working for that. But if you do working separately, no problem. Then after this, any other relevant cash flow that you have in the question, you have to indicate it here before you determine your profits. Okay. So dash this. This represents taxable profits. After the taxable profits, you are supposed to pay tax liability. So I will then come here tax at X percentage. Now, at this point, I need to ask myself, when am I supposed to pay the tax? Am I paying tax in the current year or in arrears? The question will surely tell you. If examiner is silent, you are going to assume tax to be paid in the current year that the profit is earned. So for the purpose of this explanation, we are assuming that tax will be paid in the year profit is earned. Therefore, I will just multiply the company tax rate on the taxable profit to get the tax liability. Now, because this company has incurred qualifying capital expenditure, the company is supposed to claim capital allowance. Therefore, I need to go and estimate tax saved. I need to estimate tax saved on capital allowance. So I will use the same format I showed to you the other time. So once I calculate my tax saved on capital allowance, I will come and post. This should be working number 4. Remember what I told you? The essence of tax saved or the essence of capital allowance is to reduce tax liability. If this tax saved on capital allowance is not there, this is the tax liability that we pay. But because I have incurred qualifying capital expenditure, so the difference between these two will show me the net tax that I'm supposed to pay. That means my tax I will reduce. All right. So the essence of capital allowance is to reduce tax liability. Let's say, for example, in the question also, we have scrap value. Usually, scrap value will occur at the end of the useful life of the project. Then, we also have initial outlay. Initial outlay is usually at year 0 at the beginning of the project. Also, we are assuming that this project will have working capital. So, again, our assumption will be that the working capital is in year 1. It's a one-off working capital in year 1. Therefore, we are supposed to treat it as cash outflow in the year before the year of occurrence. So I will then treat it as cash outflow here. At the end of the useful life, we recover the working capital, working number 5. So after this, we need to determine the net cash flow. Okay, so this is the net cash flow. Now, after the net cash flow, you can use any technique. From this net cash flow, you can use any technique to evaluate the project. You can use NPV, you can use payback period, you can use accounting rate, you can use accounting rate of return, you can use modified internal rate of return, project duration to evaluate the project. All right, at this point. Therefore, immediately, let's say, of course, we are calculating NPV. Immediately after the net cash flow, you need to discount. So we then say discount factor. Now, it is possible you may be the one that will estimate the discount rate or the cost of capital to be used using all those formula I shared with you earlier on, money cost of capital, real cost of capital, and all of that. So whatever the case may be, just go ahead and determine your discount factor. All right, put it here, then multiply to get the present value. Okay, so this is the present value. So immediately after present value, you have to determine your NPV. And we said that NPV represents the difference between the present value of cash inflow and present value of cash outflow. So this is our net present value. Whatever it is, either positive or negative, that's our NPV. So this is the format for calculating net present value. This is the format for calculating net present value. It's as simple as that. Just ensure you master them. Remember what I told you. This format, this columnar format, is used for calculating NPV, where you have multiple variables, where there are multiple variables. In the question, you have sales value, you have variable cost, you have incremental fixed cost, you have taxation, you have inflation, you have scrap value, you have working capital. So many variables are involved. In that case, you are supposed to use the columnar format. So that is end of the explanation of capital capital budgeting. I think this is the third class of this particular topic. All right. So let me know if you have any question for me. Then let's start illustration. Let's start illustration for the remaining minutes that we have. Okay. Now, let me start with this. I shared a question with you earlier on. Please go to your WhatsApp group, go and pick the question. I want to solve that question because it involves modified internal rate of return. Because it involves modified internal rate of return, net present value, and also project-specific cost of capital. So let's solve the question together. Let me stop sharing this. I think I have the question open. Okay. Let me share my screen with you. Please, time and time wait for nobody. I will expect you to double your efforts now, especially now that ICAN has published the exam date and fee. So you should know that if you know you are writing if you know that you are writing the May 2026 diet exam, you just have to double your effort because time and time wait for nobody. Before you wink, May will be here, and then early preparation certainly will be key to passing your exam on that day. So please ensure you double your effort. Time is going. Time is going. And once you have the financial resources to pay for your exam, please do that on time. Do that on time, particularly for those of you that are living in Lagos, somewhere that are living on the island. You know, the exam center in on that axis is a small venue, and then the earlier you pay, the better for you. You need to secure your space on time, all right, so that you don't have to be allocated to mainland. You can't be living in Aja or after Aja, Songotedo or whatever, and you are now writing an exam in Ikorodu or you are writing an exam in Unilag. It's a waste of time and resources as well. So that's why it is important. Once you have the means, ensure you pay for your exam on time and get ready. All right. So please, early preparation is very important to your success. All right. I need one of you to read this question for us, please. Now, one thing I want to mention to you is that anytime you are given a question at this level, you are not going to see any direct question. Don't go and be expecting that the kind of question you solve in the class is the same thing the examiner will test for you. No, it will not work like that. The essence of you coming to class is for you to receive guidance. All right. We want to show you the way how to do it. So the onus is on you to now go ahead and practice as many questions as possible so that you can be exposed to the scenario, the likely question you are going to meet on the day of your exams. All right. So whenever you are given this is a past question, and whenever you are given a past question you want to solve, please don't start with the body of the question. Start from the requirements. It will make life easy for you. You start from the requirement. You need to know what the examiner is asking you to do, so that by the time you begin to read the body of the question, you are going to indicate the variables that you are looking for in the question for you to be able to solve it correctly. So you just underline those variables. You already know where to go to in the section of the question for you to get the variable you are looking for. All right. So it's important you start from the requirements. So I need one of you to read for us so that within the next minutes, we can complete this question. Wherever we stop, we continue next time. Yes, who is helping us to read? Yes. Somebody should help us. Time is going. Who is helping us? I've been the only one talking since, so I want to hear your voice. Okay, let me look for somebody that will read for us. Only that I don't know who has strong internet that will not break.
Let me get sir.
All right, Tosin, go ahead.
You are required to
Start from the requirements.
Yeah, you are required to compute the appropriate cost of capital that AK PLC should use to appraise the cement project and state why you consider this rate more appropriate than the existing WACC of 11%. Note, your final cost of capital should be rounded up to the nearest whole number. State any assumptions made. B. Compute the NPV and the modified internal rate of return of the project, assuming a cost of capital of 13%. Work to the nearest million. C. Recommend whether the project should be accepted or not using both NPV and MIRR methods. 30 marks.
Okay, so now let's go to the body. Now you can see in the first requirement, examiner wants you to calculate appropriate cost of capital. Remember, anytime you want to ascertain financial viability of a project, there are three key variables that must be present. You can call it criteria, factors, determinants of project evaluation. What are those three things that must be present if you want to evaluate a project? The first one is relevant cash flow. The first item will be relevant cash flow, and we have explained this, how to identify relevant cash flow. The second point, the second variable or factor that you are going to consider if you want to evaluate a project is appropriate cost of capital. Appropriate cost of capital. Now, the cost of capital to be used to appraise the project must be consistent with the cash flow and the risk and the systematic business and financial risk associated with the project. Therefore, your cost of capital must be appropriate, not just anyhow cost of capital. And that's what the examiner is asking you to estimate appropriate cost of capital. You need to ask yourself what kind of cost of capital. Is it traditional weighted average cost of capital? Is it project-specific cost of capital? Is it weighted average cost of capital of the combined activities? You must know which one to compute. Out of those three is the appropriate cost of capital you are going to use for this project. Then the third factor to consider whenever you want to appraise a project would then be the useful life. Every project must have a useful life. Every project must have a useful life. Without, if any of these three is missing in a question, if any of these three is missing, then it will be almost impossible to evaluate or to determine the financial viability of a project. Because if you don't have relevant cash flow, what are you then? How will you be able to how will you be able to apply your appropriate cost of capital or the useful life? Again, if you don't have appropriate cost of capital, your relevant cash flow will be useless because nothing to use to discount. If you don't have a useful life, then there is nothing you are going to do because your appropriate cost of capital, you are supposed to discount your relevant cash flow using the time by considering the timing of the cash flow. So if you don't have the useful life that will tell you when the project, how many years this project will last, then in that case, there is no way you can be able to ascertain the financial viability of the project. That's why these are the key three things that must be present anytime you want to evaluate a project. Like I mentioned, Examiner can tell you, can say criteria. It can be determinant. It could be factors. It could be attributes to consider for determining financial viability or for project evaluation. These are the things we are talking about. So I just say I should branch that. Now, in this A requirement, you have to compute appropriate cost of capital. And then you are told that appropriate cost of capital the company should use to appraise cement project and state why you consider this rate more appropriate than the existing WACC of 11%. Note, your final cost of capital should be rounded to the nearest whole number. State any assumptions made. 12 marks. You want to calculate cost of capital. Out of 30 marks, you have been given 12 marks. Therefore, now that you know that you want to calculate cost of capital, you then go to the body of the question to go and identify how you are going to calculate your cost of capital. Which cost of capital? Is it traditional weighted average cost of capital? Is it weighted average cost of capital of the combined activity, or is it project specific cost of capital? We said when we discussed cost of capital as a topic, we said that cost of capital can be categorized into three: traditional weighted average cost of capital, project specific cost of capital, and then weighted average cost of capital of the combined activity, which is WACOCA. And we said that traditional WACC is computed when information about capital structure, you are given ordinary share capital, preference share capital, debt capital. You are also given dividend and interest in the question. In that case, you are supposed to calculate traditional weighted average cost of capital. When you look at this question, for example, we don't have anything about capital structure. We don't have information about ordinary share capital, preference share capital, debt capital. We don't have anything like dividend as well as the interest. So in that case, we cannot say this is a traditional work. We cannot calculate traditional work here. But in any case, I want us to continue reading so that we'll be able to identify the variables you are looking for quickly.
Okay. AK PLC is a company listed on the Nigerian Stock Exchange. It is involved in property development and sales. The company currently imports more than 60% of its cement requirements. At a recent meeting of the board of
Hold on,
directors.
Tosin. Examiner has told you that so that we are going to be using one stone to kill two birds instead of allowing Tosin to read everything through, 100%. So we are going to be pointing out some things. Now, you are told that AKPLC is involved in property development and sales. The object clause of AKPLC is property development and sales. That is what the company is doing. So read on from there, Tosin.
Okay. The company currently imports more than 60% of its cement requirements.
Take it again.
The company.
Maybe I don't. Okay. I don't know
Okay.
whether it's my network. The thing is fluctuating. Yeah, read on.
The company currently imports more than 60% of its cement requirements. At a recent meeting of the board of directors, a decision was taken to establish a division for the production of cement in Ore, Ondo State. If the division is set up and the cement production goes ahead, output from division will be sold to AKPLC and external customers at market price. For planning purposes, it has been decided that the financial viability of the project over the next 5 years should be determined.
Hold on
The
there.
sum of
Hold it
okay.
on, Tosin. Now, when you look at this first paragraph, you are told that AKPLC is involved in property development and sales. That is what the company does. The company is into property development and sales. Those people that are building houses, then they sell it to prospective clients. So that's what AKPLC does. Now, you are now told that currently, anytime that the company wants to build property to sell for sale, they import 60%. of the cement requirements. Now, at a recent meeting of the board of directors of the company, a decision was taken to establish a division for the production of cement in Ore, Ondo State. So which simply means that this company wants to diversify into the production of cement because this company is into property development and sale. They don't sell cement, they don't produce cement, but now the company wants to establish a division for the production of cement in Ore. So it means that AKPLC is diversifying into production of cement. That's what I want to point out. An examiner is asking you to calculate appropriate cost of capital. And I mentioned to you when I was explaining cost of capital, particularly under project-specific cost of capital. And I told you that project-specific cost of capital is estimated when a company is diversifying or when business and financial risk of a company are expected to change significantly as a result of undertaking a project. So AKPLC is diversifying into production of cement. That means the cost of capital that the examiner wants you to calculate represents the project-specific cost of capital. We want to calculate project-specific cost of capital. Why are you calculating project-specific cost of capital? Because AKPLC is diversifying into production of cement. Okay, so without wasting time, the next thing you need to ask yourself is that, okay, how do I calculate the project-specific cost of capital? There are 5 steps that you're supposed to carry out anytime you want to estimate project-specific cost of capital. The first thing you are going to do is to identify the proxy beta. How do you identify the proxy beta? You go to the question and check where you are given information about the proxy company. So once you get to the section of the question where you have information about the proxy, then you look out for the proxy, you look out for the proxy beta. Then that means you have identified the proxy beta. Step 2 is to ungear the beta if it is geared. That is, you calculate asset beta. Because asset beta is the same thing as ungeared beta, which measures only business risk. Therefore, you estimate asset beta. Then, depending on whether you are given debt beta or debt beta is assumed to be risk-free. Then step 3, you will re-gear the beta to incorporate the financial risk of AKPLC. Step 4, you calculate cost of equity using capital asset pricing model. And step 5, you calculate project-specific WACC. That's all you need to do. That's all you need to do. So carry on with your reading, Tosin.
Okay. The sum of 2 billion naira will be required. The sum of 500 million will be spent to acquire an existing factory considered suitable for the project. The balance of 1.5 billion naira will be applied.
I don't know whether it's my network. Let me, Tosin, let's do it this way. Let me confirm something.
Okay.
Akko, let me read this second paragraph. Let me know. I want to confirm whether it's my network because the thing is breaking. It's breaking from
Okay,
my
sir.
hand. Read on.
Okay, sir. The sum of 2 billion will be required. The sum of 500 million will be sent to acquire an existing factory considered suitable for the project. The balance of
I guess
1.5 billion.
I think it's from my side. Hold on. I think it's from my side. Because I experienced the same thing when Akko is reading now. So I think it's from my side. But I believe you guys can hear me clearly.
Yes, sir, we can. We can
All
hear
right
you.
Yes,
then.
we can.
So, all right then. So Tosin, you can then go ahead.
Okay.
Sorry, Akko, you continue later. Yeah, go
It's
on.
fine.
The balance of 1.5 billion naira will be applied for the procurement and installation of essential plants and equipment. Tax allowance can be claimed on plants and equipment at a uniform amount over 5 years with nil scrap value.
Now, let's bring down some variables in that paragraph. In this second paragraph, Examiner told you that the sum of 2 billion naira will be required. This is the initial outlay. 2 billion naira is the initial outlay of the project. You are now told that out of these 2 billion naira, the sum of 500 million naira will be spent to acquire a 16 factory considered suitable for the project. The balance of 1.5 billion will be applied for procurement and installation of essential plants and equipment. So all this information is meant for your capital allowance calculation, because when you are computing capital allowance, you do not use the existing assets. The existing assets does not qualify for capital allowance claim. All right, you can't use the existing asset to claim capital allowance, because it is assumed that the original owner of that asset is already claiming the capital allowance, and you cannot transfer capital allowance. So, and that's why the examiner is telling you here that capital allowance can be claimed on the plant and equipment at a uniform amount over 5 years. Okay, so you don't, this 500 million naira to be spent to acquire a sensitive factory, to be spent to acquire a system factory, it does not qualify for capital allowance. Anytime you are given existing assets, you are told that the company will purchase existing asset for the purpose of capital allowance. You can't claim capital allowance on existing asset, because the original owner is already claiming the capital allowance and you cannot transfer it. So that means the existing asset does not qualify. So that's the point we have in that one. Then, of course, the second point is that this is meant for useful life of the project is for 5 years. Okay, I think I've indicated it also. Useful life is for 5 years. So read on, Tosin.
Okay. The sum of 2 billion naira, oh sorry, a total of 20 million naira has been spent on various surveys, that is market, technical, financial, etc. To date, out of which 10 million naira has been paid. The balance of 10 million naira is due for payment at the end of year one.
So let me
Production of
explain hold on, let me explain that paragraph. You are told that a total of 20 million naira has been spent on various surveys, including market, technical, financial survey. To date, out of which 10 million naira has been paid. Okay? The company has spent 20 million. Out of this 20 million, you are told that 10 million has been paid. That means they have a balance of 10 million naira. Now, when I was explaining relevant cash flow, I told you that any costs that have been incurred in the past, they are irrelevant costs. Those are sunk costs. Those are historical costs. So in this particular paragraph, this 20 million naira entirely is a sunk cost and therefore should be ignored. Any cost that have been incurred in the past is a sunk cost and is not relevant to the future decision that is to be taken. Examiner is aware of the fact that there will be some average students, because examiner has told you that out of 20 million naira, 10 million naira has been paid. Some average student would think that the balance of 10 million naira is relevant. No, no. The activity has been completed. All these market, technical, financial survey have been completed before the project begins. All right. So any activity, if once the activity has been done, because your cash flow must relate to the future. So the entire 20 million naira is irrelevant. You ignore it when you are appraising the project. Read on, Tosin. Tosin.
Oh, sorry. Production of cement for the next 5 years is projected as follows. All figures are assumed to be correct. A bag of cement sells currently for 2,000 naira in the open market. This price is expected to increase at the rate of 5% per annum.
Hold on,
Variable.
Tosin. Hold on. Examiner has told you in this particular paragraph that a bag of cement sells currently for 2,000 naira in the market. So something should call your mind. That's something I just explained to you earlier today as far as inflation is concerned. I told you that when cash flows are stated in first year prices or year one prices, inflation should start from year two. Then the second one, I said that where cash flow are stated in today's prices, year zero prices, or current value terms, inflation should start from year one. So in this particular paragraph, you are told that a bag of cement sells currently for 2,000 naira. So you have been given current value. This 2,000 is in current value terms. It means that the 2,000 naira is a real cash flow. The 2,000 naira selling price is a real cash flow. Then you need to convert it to money cash flow. And you are given inflation rate for the selling price to be 5%. So move on from there, Tosin.
Variable cost is now per bag. Is that a mistake? Variable cost is now per bag. This will increase at 4% per annum. Fixed overhead costs will be 50 million at current prices, but will rise by 8% per annum. Apportioned head office charges of 25 million at current prices will rise by 10% per annum. 50% of the total initial outlay of 2 billion naira is to be funded with a loan from a federal government. Please call up, sir. From a federal government development bank at a concessionary fixed interest rate of 8%, payable at the end of each year. Half of the loan will be repaid at the end of year 3, while the balance will be paid at the end of year 5. The project will require a working capital of 10% of annual revenue, and this should be available at the beginning of each year. Should I go on, sir?
Go ahead. Now, let me just mention something here. In this paragraph, ordinarily, the information that are relevant, we are given selling price of 2,000 naira in current value terms, which means that we should start inflating from year one, and we are given inflation rate of 5%. We're also told that variable cost is now per bag. So you are given the cost of the variable cost. So something is missing there. That is 800 naira. The variable cost is 800 naira. So that is an error from the question, but there is 800 naira there. This one is now 800 naira per bag. All right. So variable cost has been given. The examiner told you now means today. That's today's price. That means inflation should start from year one also. Then you are given inflation rate of 4%. Your fixed overhead cost will be 50 million naira at current prices, but will rise by 8% per annum. Okay? So this fixed cost, you need to know. There are 3 ways examiner can test you because of time is okay. Let me allow you to read because of time. We have about 15 minutes more to go so that we can, if it's only cost of the A part of the question, we can solve today. So just go ahead with your reading, Tosin.
Okay, please call up, sir.
Yeah.
Up. The company uses a current weighted average.
Go ahead.
The company uses a current WACC of 11% to appraise all capital projects. The asset beta of the company is 1.2, equity beta is 1.6, risk-free rate is 5%, while the market risk premium is 7%. The finance director is of the view that it is not appropriate to use the existing WACC to appraise the new projects. He has identified a listed company which currently produces cement and packaged food drinks. The company has the following financial statistics. Equity beta
Hold
1.8.
Hold on, Tosin. In this paragraph, you are told that the finance director is of the view that it is not appropriate to use the existing work to appraise the new projects. He has identified a listed company which currently produces cement and packaged fruit drinks. So that means this is the proxy company we are looking for, right? You are told that the finance director has identified a listed company which produces cement and packaged fruit drinks. So, and this particular company, this proxy company is into production of cement and packaged fruit drinks. Read on.
Equity beta 1.82, debt beta 0.4, and debt to equity ratio is 40%. 60% of the market value of the company is attributed to cement production, while 40% of the value is attributed to the fruit drinks division. The food drink division has equity beta of 0.8. The new project is expected to move AKPLC to the target debt to equity ratio of 30%, tax rate to 25% for the two companies, and is paid in the year profit is made. They are required again to
All
compute
right.
the appropriate cost of capital. Okay.
So thank you. Let's stop there. Thank you, Tosin. Now, examiner is asking you to calculate appropriate cost of capital. So like we have identified from the question, AKPLC is diversifying into production of cement in Ore. So that means the company that produces, the company that is into property development and sales is now diversifying into production of cement in Ore. So this means that an examiner is asking you to calculate appropriate cost of capital. In this case, we are supposed to calculate project-specific cost of capital. And then in calculating the project-specific cost of capital, we have identified information about the proxy company, because we are told in the question that the proxy company produces cement and packaged fruit drinks, which means that all these statistics given to you for the proxy company are meant for cement and packaged fruit drinks. And you are given equity beta of 1.82. This 1.82 is for cement and packaged fruit drinks. Meanwhile, you are looking for beta of cement because AKPLC is diversifying into cement. So the proxy company that AK has identified, they don't produce cement alone. They also produce packaged fruit drinks. Therefore, this 1.82 is a combined equity beta. This 1.82 is a combined equity beta. Let me put it by the side. This is a combined equity beta because it's meant for fruit drinks and then cement. So that means we are not given the beta of cement. So you are given combined equity beta. How do you then estimate the beta of cement? How do you calculate? Not only that, in the question, examiner also give you equity beta of the fruit drinks. We are told that the fruit drinks division has equity beta of 0.8. Therefore, where is the equity beta of cement? An average student can say, okay, since I'm given equity beta of the combined, this is equity beta of the combined, then I'm given, this is 1.82, and I'm also given equity beta of fruits, all right? Equity beta of fruits. Okay, equity beta of fruits equal to 0.8. Therefore, since I'm given the combined equity beta is 1.82, I'm given equity beta of cement to be 0.8. Therefore, the equity beta of cement, equity beta of cement is equal to 1.02? 1.02. If you do that, you're on your own. Yeah, this is not the way to do it. In any case, let's move on because let's see what we can achieve before we close the class for today. All right. So let me stop sharing this so that we can quickly solve the A part. Let me move to the working note quickly. And then please open to the material at your end. I've shared the material already. So this is solution. This is solution. . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . So, question 1, November 2014. Okay. So, the name of the company is AK PLC. Requirement number A, we are to calculate appropriate cost of capital, and we have identified that this is project specific. I would then say calculating project specific cost of capital. Cost of time, let me shorten it. Project specific cost of capital. And we said that when you are calculating project specific cost of, there are 5 steps. The first step is to identify proxy beta. You ungear the beta, you regear the beta to incorporate financial risk, you calculate CAPIMS, then you calculate WACC. So these are the 5 steps that you are supposed to carry out to calculate project specific. So I would then say step 1, there's no need for you to say identify a proxy beta, just move on. So you can just say proxy beta of cement. Remember, AKPLC is diversifying into the production of cement in Ore. So we have looked at the question. We are not given the beta. We are not given equity beta of cement. So you are going to use the variables that you have to get the unknown variable. Therefore, this is beta. I can then say, since for the purpose of this class, let me just put it down for you. Since equity beta of cement, since equity beta of cement is not given, the following statistics, the following information or statistics available for the proxy company will be used to estimate the beta of cement, to estimate the beta of cement. So quickly, in the question, we are given combined equity beta, combined equity beta, equity beta. So let me call it beta equity of the combined, beta equity of the combined to be equal to 1.82. We're also given equity beta of fruits to be equal to 0.8. Not only that, we are given market value of cement for the proxy company to be equal to 60%, which is 0.6. We're also given market value of cement, fruits. Market value of fruits to be equal to 40%, 0.40. All right. So with this little information, we should be able to estimate beta equity of cement. Okay. So like I said, equity beta of cement is not given. Equity beta of cement equal to unknown. We don't know it. That's what you want to calculate. Is unknown. Therefore, now, you will recall that You will recall that when we had WACOCA, I gave you 7 procedures for calculating WACOCA. The 4th procedure, which is to calculate weighted average asset beta, the formula we use for the weighted average asset beta is the same formula we are going to use here to estimate the beta of the cement. What do I mean by that? So let me just put it down for you. To calculate the beta of cement, that is beta equity of cement. Let me call this one combined equity beta. Combined equity beta. So the beta, to calculate the beta equity of cement, the following formula or the formula below, or you can say the beta equity of cement can be calculated using the formula below. Let me reframe it. The beta equity of cement, BEC, can be calculated using the formula below, or can be calculated as follows. Okay, so you have to be open-minded. Don't box yourself. That's why I usually advise students not to cram, because you need to be able to open your mind. We have identified from this question that the equity beta of 1.82 is a combined equity beta, and you are looking for beta equity of cement. That means something would have called your attention, that you have what formula can you use to determine the combined equity beta? That is why I was telling you that the formula we use in step 4 under WACOCA is the same thing we are going to use to calculate the beta equity of cement. I can use another method, but because I can use known variable to get the unknown variable. But since you have a formula that you can use, why don't you use the formula? So this is what I'm saying. I would then say combined equity beta equal to beta equity of cement multiplied by total market value of equity and debt of cement over total market value of equity and debt of cement and fruit drinks. This is 1 plus, open a bracket, beta equity of fruits multiplied by total market value of fruits over total market value of cement and fruit drinks. Okay, that's it. At this point, all I need to do is to just put the variable there. Combined equity beta. We are given combined equity beta to be 1.82. Here is 1.82 equal to, we are looking for beta equity of cement. That's what we are looking for. We don't have it. So here will be BEC multiplied by, we are told in the question that market value of cement is 60%. So 60 over 100 is 0.6. So 60 over 100, this is 0.6. 60 plus 40, that's 100. So I will just say 0. Instead of me to be doing 60 over 100, 60 is for cement, 40 is for fruits. 60 plus 40, 100. 60 over 100 will give us 0.6. So no need to be doing 60 over 100. That's a waste of time. Plus, open a bracket, beta equity of fruits, we are given 0.8. Here is 0.8, then multiply by market value of fruit drinks is 40%. Here is 0.40. So from this other side, here will be 1.82 equal to 0.60 BEC plus 0.32 Then we collect like terms. We collect like terms. So here will be 0.60 BEC, then equal to 1.82 minus 0.32. Okay, so you then make BEC the subject. So here will then be BEC, beta equity of cement will then be equal to, this should be 1.50, right? Is it 1.5? Yes, that should be 1.5 divided by 0.60. What do we have here? BEC will then be equal to, support me, what's your answer?
2.5.
2.5.
Okay, 2.5. So beta equity of cement is 2.5. So this is what examiner has hidden. This is what examiner has hidden in the question. Now we have gotten it. Therefore, we then move to step 2. Step 2 of work of project specific is to ungear the beta if it is geared. Now that you want to ungear, and I said that this beta of 2.5, is it geared or ungeared? Of course, because examiner has given us debt equity proportion of 40% for the proxy company, so it means that the 2.5 beta of cement of 2.5 is a geared beta. If it's a geared beta, then we need to ungear it. Yes, Tosin, talk to me.
Sorry, sir. What about this denominator, this TMV, total market value of C and food that we did not factor in?
That's what I said now. I said instead of you doing, see, you are told that cement is 60%, fruit is equal to 40%. When you add the two together, that's 100. So instead of me to come here to say equity, I mean the cement is 60 over 100.
Okay,
It's a
sir.
waste
Sir.
of time. You already know 60 over 100 is 0.6.
Yes.
So that's what we did there. So no need to do 60 over 100 again. If you do 60 over 100, it's still the same thing, but it's a waste of time. Okay, so the 2.5 is a gear beta, so we need to ungear it. How do we ungear? Before you put down your formula, you must check from the question to confirm if you are given debt beta or debt beta is assumed to be risk-free. According to the question, we are given debt beta. Yes, we are given debt beta for the proxy company of 0.4. In that case, that means you are going to use the extended formula. So debt beta of 0.4 is given for the proxy company. Therefore, the asset beta will be calculated as follows. Okay, so you then use that bit for nothing formula. So asset beta equal to beta equity of a gear multiplied by equity value over equity plus debt multiplied by 1 minus tax rate plus debt beta multiplied by debt value multiplied by 1 minus tax over equity plus debt 1 minus tax rate of the proxy company. You have to be very careful. It's not at all time that examiner will give you the same tax rate for the proxy and the main company. So you have to shine your eye. Now, beta assets, that's what we want to calculate, equal to 2.5. That 2.5, we said it is geared. So I need the gearing ratio of the proxy company. I need the debt equity proportion of the proxy company. And the examiner has told us that the debt equity ratio is 40%, which means that debt is 40%, equity is 60%. So an examiner did not define the gearing ratio for you. So you're at liberty. You can either use total method or you use you use a single method. What do I mean by that? Remember when I was explaining in your theories of gearing, if you want to calculate gearing ratio, you can say gearing ratio equal to debt over equity. This is single method. So in this case, it will be debt over equity. So for the purpose of this class, I can say debt is 40%, then equity is 60%. If I want to use total, then in this case, it will be debt, gearing ratio will be debt over total value, that is debt plus equity. So in this case, debt will be 40, then equity will be equal to 40 plus 60, which is 100, because I'm using total. So debt will be equal to 40, then equity will be equal to 100 if I'm using total. But if I'm using the single one, of course, once you are given the percentage of the debt, then the balance will then be the balance of the 100 will then be the for equity. So in this particular question, the examiner did not define the gearing ratio. We are just given debt equity proportion of 40%. Therefore, I can say debt is 40%, equity is 60%. So I would then say 60, which is equity value, over 60 plus 40, multiplied by, I need the tax rates. Let me remove all this. I need, what's the tax rate of the proxy company?
5%.
25. Did you say 25?
Yes, sir.
Let me check. Okay. So we are told that the new project is expected to move AKPLC to the targeted equity ratio of the tax rate is 25% for the two companies. Yes, the same tax rate. So if tax is 25%, that means we are supposed to account for 75%. Plus the other side, we are given debt beta to be 0.40, 0.4. Okay, debt value is 40. 1 minus tax is 0.75 over 60 plus 40 multiplied by 0.75. That's it. Who says SFM is difficult? Just know what you are doing. The only thing is that when you are writing exam, you are working under tension, under immense pressure, right? When you are in the class, the thing will be suiting you. But when you are in the exam hall, even when the AC is fully working, you'll be sweating. God will make it easy for all of you. All right, let's take it from the left. Quickly, what do you have from the left? This will be 0.7.
0.8.
Okay, 0 point, everything from the
No,
left.
no.
So you are going to do
So
0.75
2.5.
of 40, that should be 30, plus
Eh?
60, that's 90. 60 over 90 equal, multiplied by 2.5. What do you have?
Sir, hold on now.
Aha. 60.
Okay, 0. So 2.5. Should I do the whole answer?
Yes, so
Okay.
that's what I said. 60
Times
over
2.5.
90.
So the first one is 1.666.
1.67, right?
Yes,
That's
1.67.
1.67, then plus the other side, 30 over 90 multiplied by 0.4. 30 over 90 multiplied by 0.4.
0.133.
0 point what?
133.
Okay, 0.13. So when you add the two together, beta asset will then be equal to 1.80. Asset beta is 1.80. This asset beta will measure the risk associated with cement industry. Then step 3, Remember, I said step 1 and step 2. You need the information about the proxy company. From step 3 to step 5, you need the information about the main company. Now you need to regear. You regear to incorporate the financial risk of AK PLC. So let's go back to the question to confirm whether we are given debt beta for AK. Does AK has a debt beta? So we are told in the second paragraph before this, in the paragraph before the proxy company, that AK PLC has asset beta of 1.2, equity beta of 1.6, risk-free rate of return is 5, market risk premium is 7. So we are not given debt beta of AK. So it means that debt beta is assumed to be risk-free for AK. So I can then say, since debt beta of AK is not given, of AK PLC is not given, it is assumed to be risk-free. Okay. Therefore, the gear beta will be calculated as follows. So I would then say beta equity of a gear equal to beta assets multiplied by 1 plus 1 minus tax debt equity proportion of AK PLC. So beta equity of a gear equal to asset beta of 1.8 we calculated in step 2, yes. 1.80 multiplied by 1 plus 1 minus tax. We are told that the tax rate of AK is also 25%. That means we are supposed to account for 75%. Multiplied by the debt equity proportion of AK. Are we given debt equity proportion of AK? Yes. In the last paragraph, examiner told you that the new project is expected to move AK PLC to the target debt equity ratio of 30%. So debt is 30%, equity is 90%. So here will be multiplied by 30 over 70. All right, so beta equity of a gear will then be equal to 30 over 70, 30 divided by 70 equal, multiply by 0.75 equal, plus 1 equal, then multiply by 1.8 equal, that's 2.38. 2.38, here will be 2.38. All right, so the beta equity of a gear, the beta equity of AKPLC is 2.38. Then step 4. Step 4 says you should calculate capital asset pricing model, that is cost of equity using capping. So I would then say cost of equity equal to risk-free rate of return plus beta multiplied by market return minus risk-free rate of return. All right. So according to the question, what's the risk-free rate of return? We are given risk-free rate of return to be, yes, to be 5%. Risk-free rate of return is 5%, is the market information, so it's 5%. And then risk premium is 7%. So here will be 5 plus the beta we calculated in step 3 is 2.38. The difference between market return and the risk-free rate of return, we are given as 7. That's the risk premium. Therefore, cost of equity will then be equal to 2.38 multiply by 7 equal, then plus 5 equal to 21.66. 21.66%. Then finally, step 5. We then calculate the WACC, project-specific WACC, denoted as KW. So WACC will be equal to equity value over equity plus debt, multiplied by cost of equity plus debt value over equity plus debt, multiplied by cost of debt 1 minus tax. All right, that's it. So the market value of equity is 70% because you are given debt equity proportion of 30%. It means that equity is 70%, debt is 30%. So if you like, you can say 70 over 100 or just say 0.7. You are still saying the same thing. Don't waste your time. Just put 0.7 there and move on. Multiply by cost of equity of 21.66% plus the debt equity proportion of the debt side is 30%, so 0.30. Multiply by, I need cost of debt, KD. So the cost of debt, KD, according to the question, let's see, where do you have information about cost of debt? There's a place where the examiner was talking about method of financing. Yes, you are told that in the 1, 2, 3, 4, 5. In the paragraph 5, you are told that 50% of the total initial outlay of 2 billion is to be funded with a loan from a federal government development bank at a concessionary fixed interest rate of 8%. You are given interest rate, your KD is 8%, your cost of borrowing is 8%. All right. So if that is the case, I would then say multiply by 8%. Multiply by 8%, then multiply by 1 minus tax rate is 0.75. So from the left, 0.7, 0.7 multiplied by 21.66 equal that 15.12. Is it 0.12 or 0.16? Let me confirm again.
162.
15.16%. Then from the other side, which is 0.3 multiplied by 8 multiplied by 0.75 equal 1.8. There is 1.8%. Then you add the two together. That will give us 16.96 or thereabout. Let me use calculator. Plus 15.16. That's 16.96. Here is 16.96%. So approximately our WACC is approximately 17%. That's it. You cannot earn your full mark. That 12%, that's 12 marks. You cannot earn it if you don't state your assumption. So first thing first, examiner is asking you in the requirement to compose the appropriate cost of capital, which we have done, and state why you consider this rate more appropriate than the existing WACC. Your final answer should be rounded to the nearest whole number. State any assumptions. So quickly, we have about 2 minutes more just to go. I would then say the appropriate cost of capital for evaluating cement production is approximately 17%. So that's not sufficient. Examiner also asks you to state why you think this rate is more appropriate than the existing WACC. You can then say the existing WACC of 11% is not appropriate, is not suitable for evaluating the cement project because it does not account for, or it does not reflect the systematic business and financial risk of the cement production. That's why the existing work is not suitable. So no need to talk too much story. Then the last thing you are going to talk about to earn your full marks is to state your assumptions. Okay? So in stating the assumptions, you can talk about business risk. Okay? What do you mean by business risk? It is assumed that both AK PLC and the proxy company have similar business risk. That's why you are borrowing the beta of the proxy. That's number one assumption. The second assumption is debt equity proportion, debt equity ratio. Okay, so we can say that the debt equity proportion, the debt equity ratio of the proxy is 40%. Therefore, it is assumed that debt is 40% and equity ratio is 60%. Okay. Then you can talk about debt beta. Number 3, assumption is debt beta. So you can say the debt beta of, let me write that. The debt beta of AKPLC is not given. It's not given. Hence, it is assumed that debt beta is risk-free. So these are some of the assumptions we made in the calculation of our appropriate cost of capital. So that will be the end of the question. I've already delayed you beyond the normal time. So in our next class, by the grace of God, we are going to be solving the B and C parts of the question. All right. So let me know if you have any question for me so that we can close the class. Any question? Okay. Some of you have disappeared. That's all right. Yes. In the absence of no further question, I want to say thank you to every one of you, particularly for waiting behind to the last moment. Thank you. I do appreciate that. Good night, everyone.
Good night,
Yeah,
sir.
Tosin.
Good